you considering retiring in your 50s and wondering what happens to your Social Security benefits? You see, retiring in your 50s is the financial equivalent of looking at a marathon. You see, we've all ran around a track at least once in our life, but we all know the amount of hard work, dedication, and sacrifice that it takes to want to do that 105 times for 26 miles. But what if this early retirement comes with hidden threats to your Social Security benefits? What if there are specific strategies to protect and maximize your Social Security when you retire early? So stay tuned to the end of this video where I'm going to share with you 4 crucial tips that could transform how you approach your retirement planning and ensure that your benefits are worked harder for you. Because one of the first things that you need to know is that Social Security benefits aren't available at 55. In fact, the earliest you can claim is at age 62. So if you're looking to maximize your benefits, waiting until full retirement age or 67 for those born in 1960 or later, or even 70 years old when your benefits reach their peak may be your best bet. This means retiring at 55 requires you to usually self-fund your lifestyle for at least 7 to 15 years before Social Security can play a role in your income strategy. So how do you bridge that gap? Well, let's look at some financial strategies that can help you maintain your lifestyle in the years before Social Security kicks in. To begin with, you might turn to your 401k and the rule of 55, because if you left your job and are at least 55 years old, then the IRS allows for penalty-free withdrawals from your 401k tied to your most recent employer. However, this does not apply to IRAs. And if the penalty is waived, withdrawals are still subject to regular income tax. Careful planning is crucial to ensure that you don't deplete your funds too quickly. Now, another option is 72T distributions. These allow you to take what are called substantially equal periodic payments from your IRA or your 401k without the 10% penalty. However, there are strict rules that you have to follow. The payment must continue for at least 5 years or until you turn 59 and a half, whichever is longer, and any changes can result in retroactive penalties. Now, this approach can be a really good alternative if the rule of 55 doesn't apply, but I would highly recommend you getting professional guidance on this. Now, you may also rely on other sources like pensions if you have one, or a diversified taxable investment portfolio, because a mix of other assets can provide steady income during the transitional period. Now, the key here is to ensure that your savings can support you for an extended withdrawal period without prematurely exhausting your resources. But what about the impact that retiring at 55 could have on your Social Security benefits? You see, Social Security calculates your benefits based on your 35 highest earning years. So if you retire with fewer than 35 years of earnings, then zeros are factored into the calculation, which lowers what they call your average index monthly earnings and ultimately your monthly benefit. For instance, if you worked for 30 years earning $50,000 per year, your earnings would be divided by 35 instead of 30, significantly reducing your benefit. See, on top of this, retiring early also means that you may miss out on your peak earning years. And so for people that are in their 50s and early 60s, that represents some of the highest income levels of their career. So by leaving the workforce at 55, you're forfeiting the chance to replace your earlier, lower earning years in the Social Security formula with higher earning ones. Now remember, pre-age 60 earnings are indexed for inflation, while post-60 earnings are taken at face value, meaning that those later years are even more valuable. So how do you navigate this trade-off? Well, one strategy that you can utilize is you can work part-time or take on freelance roles during early retirement. Not only does this provide supplemental income, but it also allows you to add higher earning years onto your Social Security record, reducing the impact of zero income years. Delaying Social Security benefits is also another powerful tactic. You see, waiting beyond full retirement age can increase your benefit by approximately 8% per year until 70 years old. For example, if your benefit at full retirement is $1,800, well, claiming at 62 reduces it to $1,260, while waiting until 70 boosts it to $2,232. And so over the lifetime, that difference can amount to tens of thousands of dollars. And for married couples, optimizing spousal benefits can further enhance your retirement income. You see, by delaying your claim, you can increase your spouse's survivor benefit, providing greater financial security for them long term. It's also critical to regularly review your Social Security earnings record to ensure that all of your income has been accurately reported. You see, mistakes can lower your benefit, but these errors can often be corrected by providing proof of earnings to the Social Security Administration. And let's not forget the value of Roth accounts for supplemental income. See, because Roth IRAs and Roth 401ks offer tax-free withdrawals in retirement, they can be invaluable when it comes to that time. Importantly, these withdrawals don't count as taxable income, which helps you avoid exceeding the income threshold that could trigger taxation on your Social Security benefits. For example, if you need $50,000 every single year and withdraw $30,000 from a taxable 401k and $20,000 from a Roth account, only the $30,000 counts as taxable income. This strategy can help preserve your Social Security benefits and manage your overall tax liability. You see, retiring in your 50s presents both opportunities and challenges, because for most people retiring in their 50s, Social Security isn't the biggest factor in their long-term retirement. But just because it isn't the main focus, that doesn't mean that it should be overlooked. And by carefully managing your withdrawals, considering partial employment, and leveraging tools like Roth accounts and delayed claiming, you can maximize your benefits and secure your financial future. So what about you? Are you planning to retire in your 50s? If so, how are you preparing to bridge the gap until Social Security kicks in? And lastly, if you found this video helpful, do me a favor, hit that subscribe button and share it with someone who might be considering early retirement. Thank you for watching, and make sure you check out this video coming up next, where I break down 8 things that you need to stop doing after 50 years old to live a happier life. I'll see you there.